Have you ever accepted equity and later wondered what that percentage actually meant? Are you confusing ownership percentage with real money in your pocket? Do you know which small question to ask now that would change your long-term outcome? These questions frame everything we'll cover. Answering them clears confusion, helps you negotiate smarter, and turns paper promises into real options. Equity versus salary explained. The quote reads, "Salary pays bills, equity builds futures." Start here. That line nails the difference. Salary is guaranteed cash, equity is ownership and optionality. If you're wondering which to favor, think about your runway, responsibilities, and time horizon. Pair this with the handout at link for quick checks. Agenda. The slide lists salary versus equity, equity context and dilution, valuation basics, takeaways, reflection. Reveal 1, salary versus equity. We'll define it plainly. Reveal 2, equity context and dilution, why percent alone misleads. Reveal 3, valuation basics, why valuation is belief, not cash. Each item previews a practical question you'll be able to answer by the end. Ready to elevate your financial impact? The intro says you'll understand how compensation choices shape wealth. That's the promise. So when you hear equity, translate it. What type is it? When does it vest? And what happens at an exit? Simple habit, always convert percent, plausible cash scenarios. That habit solves most confusion. Lesson 1, salary versus equity. The bullets. Salary equals cash flow today. Equity equals ownership and long-term upside. Choice depends on risk and life stage. What it means, salary keeps your lights on. Equity is a bet on growth. Why it fits here. Before modeling cap tables, you must know your personal constraints. How to fix a common mess up. People treat equity like free money. Don't. Fix. Calculate minimum livable salary, then treat equity as upside. Book Rich Dad Poor Dad for Asset Mindset. Lesson 2. Equity only matters in context. Bullets 1% equals different outcomes by valuation. Know the type, options, RSUs, founder shares. Ask about the cap table and future rounds. What it means, percentage is noise until you know the math. Why it builds on the prior slide. Once you accept risk, you must quantify it. Example, 1% at $1 or 1% at 1B, worlds apart. How to fix your mistake. Stop anchoring to percent. Request pre-post money valuation and total shares. See venture deals for how investors view this. Lesson 3, how dilution works. Bullets. Dilution reduces percent ownership. Value can increase faster than ownership shrinks. Focus on value per share. What it means, dilution is not automatic loss, it's the trade for growth capital. Why it fits, you'll see dilution in most funding paths. Example, 10% of $1 diluted to 5% of $10 is still a win. How to avoid panicking. Model value per share across plausible rounds, not just percentages. Context from the lean startup. Lesson 4, valuation cash, bullets. Valuation is investor belief, not immediate liquidity. Pre-money versus post-money matters. Use conservative scenarios. What it means, a $50 valuation doesn't mean you can cash out tomorrow. Why it builds on dilution. Valuation drives how dilution translates to value. Common mess up, treating paper valuation as spendable cash. Fix, always map valuation to exit path, acquisition, IPO, secondary sale, and set realistic timelines. Reference McKinsey's valuation frameworks. Lesson 5, risk, time, and personal leverage. Bullets, younger equals more time leverage, later equals prioritize cash flow, hybrids often win. What it means, your life stage should shape compensation choices. Why it's motivational, owning a piece of something big compounds if you can wait. Example, early employees who tolerated low pay for equity saw outsized returns when companies scaled. How to correct errors, don't overplay long odds if you have immediate needs. Choose hybrid deals and negotiate protective terms. Inspired by designing your life. Try this. Actionable takeaways. Bullets. Map minimum living salary. Model cap table and dilution scenarios. Translate equity to realistic exit value. Reassess annually. What this does, converts vague promises into checkable steps. Quick anecdote. An engineer turned down a higher salary because they hadn't modeled dilution. Later realized the equity wouldn't net out. Fix. Build a one-page model this week using the PDF worksheet. Reflection. The slide asks, what risks are you underestimating? Does your equity match long-term goals? Which step today increases optionality tomorrow? Pause and journal one sentence per question. These simple reflections expose hidden biases like overvaluing title or percent, so you can correct course. Master your compensation decisions. The slide reminds, salary pays bills, equity builds futures. Small clarity compounds, what to do now, ask for cap table info, vesting schedules, and a conservative exit scenario in your next negotiation. Common error, accepting equity language without legal clarity, fix by requesting written terms or at least a summary email. Get the PDF handout at PDF link. Use it to model scenarios and prepare negotiating questions. As you use it, remember Housel's idea. Clarity turns risk into strategy. Want a practical nudge? Subscribe to the channel for more short guides and templates that simplify these conversations.